Imagine a bank. You know what it does. It takes deposits, makes loans, and helps you pay your bills. That's the friendly face of finance. But behind this front door, there is a giant, chaotic factory that churns through trillions of dollars every single night. This factory is the Repo Market. Repo stands for Repurchase Agreement, and while it sounds boring, it is the grease that allows the entire global financial machine to spin. Without it, the machine grinds to a halt. In September 2019, that machine nearly stopped dead. Overnight interest rates suddenly exploded, sending shockwaves through Wall Street. Today, we're going deep into the plumbing of finance to explain what the repo market is, why it's so fragile, and why its silent failure would affect every person on Earth. Let's start with the basics of a bank's day. Banks deal in huge amounts of money. At the end of every business day, every bank has the same problem. Balancing the books. They might have too much cash, or more often, they might have too little cash to meet their legal obligations. They need a quick, safe overnight loan to cover the gap. They can't just ask another bank for a regular loan. Those take too long. They need a system designed for speed and security. Enter the repo market. This is where banks and financial institutions lend money to each other, but with a massive safety net. It's like a super secure pawn shop for banks. Here's how a repo works. Bank A needs cash. They temporarily sell a high-quality asset, usually a U.S. Treasury bond, to Bank B. Bank B gives them cash overnight. The next morning, Bank A repurchases the bond at a slightly higher price. That small difference is the interest. This transaction is incredibly safe because the loan is backed by super secure collateral. The government bond. If Bank A fails to repay, Bank B simply keeps the bond. This safety net allows trillions of dollars to flow seamlessly every single night. The interest rate for these overnight loans usually hovers around the Fed's target rate, which at the time was about 2%. It was boring, predictable. But on September 17, 2019, the rate went wild. Instead of 2%, the overnight rate shot up to 10%. That's a 5-fold increase. Suddenly, banks that needed cash couldn't get it, or they had to pay 5 times more than usual. The grease dried up. The machine was seizing. Why did this happen? It was a perfect storm of predictable yet poorly managed events that drained the system of cash. First, it was a big tax day. Corporations had to pay their quarterly income taxes to the government. This moved huge amounts of cash out of the commercial banking system and into the Federal Reserve's account. Second, the U.S. government was issuing new treasury bonds. When they issue new bonds, banks buy them, which moves more cash out of the system and into the government's hands. Think of the financial system as a giant bathtub. Normally, cash flows smoothly, but on this one day, 2 giant drains, tax day and bond sales, opened up at the same time, sucking billions out and leaving banks scrambling for liquidity. With less cash circulating, the banks that did have money suddenly had all the power. The price of an overnight loan, the interest rate, shot up from 2% to 10% because demand far outstripped supply. This spike showed how brittle the post-2008 financial system still was. If the Fed hadn't acted quickly, the problem would have spread. The 10% rate was a massive red flag. If banks can't borrow safely, they won't lend to anyone else. Businesses, mortgages, credit cards. The entire credit ecosystem freezes. It's a classic bank run, but happening silently between institutions. This is where the Fed, the U.S. central bank, rode in like a fire engine. The Fed's job is to ensure liquidity, to be the lender of last resort. They launched what's known as repo operations. For the first time since the 2008 crisis, the Fed began pumping massive amounts of cash, billions, then hundreds of billions of dollars, into the repo market. The vault door swings open, revealing a blinding white light and a massive surge of water-like cash flowing out. The Fed essentially stepped in to replace all the normal banks that had stopped lending. They became the giant reservoir refilling the financial bathtub. This was a huge intervention. Initially, they planned a temporary fix, but the liquidity problem didn't go away. The Fed had to continue injecting cash for months, eventually pledging over $4 trillion to keep the market stable. The banks had created a liquidity dam that restricted the flow of money. The Fed had to use its balance sheet like a fire hose, blasting cash into the system until the natural flow returned. The core issue? Post-2008 regulations meant banks held less readily available cash compared to the size of their total assets, leaving the system overly reliant on the fragile nightly repo market. The crisis revealed that even minor, predictable events could cause the essential plumbing of global finance to seize up entirely. The machine needs constant, massive cash injections to simply function. The key takeaway from the 2019 repo crisis is this: complexity equals fragility. The modern financial world is built on a web of trillions of dollars, moving in the dark, held together by the thin thread of overnight trust. When that trust breaks, the solution isn't magic or innovation. It's the central bank stepping in with historic amounts of freshly created money to restore order. The price of stability is eternal vigilance over these invisible systems. If you now understand the repo market better than your banker, hit the like button and subscribe. What other complicated financial mechanisms should we pull apart next? Let us know in the comments below.